Joining us now is David Rosenberg, founder of Rosenberg Research. David, he continues to make the point that he doesn't think that the coming inflation is going to last year after year in a way that the Fed should do anything about it. I know you agree, right, that inflation is not a threat, even though we have so many fund managers and strategists coming on here every single day say you have to position for rising inflation. Why are they wrong?
Right. There's a famous Bob Farrell rule in his 10 rules to remember, which goes like this. It goes, when all the experts and consensus agrees on something, that the exact opposite is going to happen. Look, you go back to the beginning of the last cycle, Sarah, and everybody was saying the same thing, that the zero rates and the repeated QE out of Bernanke, the Obama infrastructure package. Then, of course, we finished off the cycle with $1 trillion tax, with a $2 trillion deficit, 3.5% unemployment. I mean, think of the last cycle. We created all those conditions to create a huge inflationary cycle that never happened, which tells you there's a lot of structural factors at play that continue to impede the inflation process. And I would say actually one of them is excessive indebtedness, which now we have a lot more of on the books than we had previously. We're going to have near-term inflation. There's no doubt about it for the next few months. But I think Powell is quite right. You know, you can't have a central banker whacking around interest rates like portfolio managers can do to their portfolio. If the Fed believes, and I think they're right, that we're going to have a short-term deviation from the trend line, then you don't do anything. You only do something when you actually believe the trend line is going to change. And I think that, you know, once we get past all this temporary stimulus later in the summer, into the fall, we're going to recreate the conditions for what happened in the fourth quarter of last year, which is that we're going to have an economic relapse on our hands. I'm not saying negative, but I think we're going to have a very big slowdown. You know, Powell can't talk about this because you got Janet Yellen being the nation's economic cheerleader. But what I find interesting is that when you go to the Fed's forecast in the last meeting and you look at what they did to this year's GDP growth, and then you back out the quarterly pattern, I think that they agree with me. They won't come out and advertise it, but I think the Fed has a fourth quarter zero for GDP growth this year. So why would you do anything with interest rates knowing that? So
just to be clear, so you're saying that a lot of this boom that we're seeing in growth and across the economy is just artificially driven by stimulus, and there's going to be a ton of give back when it goes away? That's not the consensus. The consensus is we're building a sustainable recovery that could last years.
Well, I realize where the consensus is. What I'm saying is that all the stimulus, I'm not saying it's artificial, it's real, but it's also very transitory. Uncle Sam did not give the economy a national wage increase. This is like we got a temporary bonus. So what happens when your bonus runs out? And so we're going to find, of course, we got the reopenings. We're going to have a nice little party for a couple of months. The economy in most parts of the country, from what I hear, I'm here in Toronto, I'm hearing that most of the U.S. is already reopened. We're probably 3/4 of the way there. That impetus to growth is soon going to subside, just as the stimulus checks run out. So what I'm saying is that, yeah, I can understand the consensus is a completely different view than my view, which makes this all the more exciting for me, especially in terms of how you want to be trading bonds and the forward curve and Eurodollar futures that are priced in early Fed tightening. That's actually where the money's going to be made. So I'm very excited of the fact that the consensus and I have parted ways.
Shepard Smith here. Thanks for watching CNBC on YouTube.